Remember, the markets are closed for the Juneteenth holiday. Dow's off 300, Nasdaq's down 200 points. Tom Hayes joins me now to check out the market, even though it's closed today. All right, Tom, Trump says that Jay Powell at the Fed should lower rates right now. Is he right?
He's not only right, he's been right every single step of the way, Stu, about too late Powell. So the good news is we're going to get 2 cuts this year, 64% chance starting in September. They'll probably set the table at Jackson Hole. The bad news is, in the meantime, we're paying 200 basis points above inflation in terms of our debt service, which equates to about $600 billion a year. Who pays that, Stu? We pay that as taxpayers. It's completely unnecessary. You know who else is getting hurt from this wrong-minded policy? The millennials. 72 million millennials are trying to start a house, a family formation. They can't do it at 7.25% 30-year fixed rate mortgage. Home builders can't take the risk with their capital at 7% and speculate that people are going to buy it. They'll just sit there in inventory. We need to come down 200 basis points. And President Trump has made the case. If he's right about his prediction that inflation is going up, he can always hike 25 basis points. It's much easier to quell inflation than to deal with deflation or unemployment by being too late.
Maybe this is a technical question, but the president wants 1 full percentage point drop in interest rates. If he did that, would the yield on the 10-year Treasury come down 1 full percentage point, 100 basis points? And would that lead to a drop in the mortgage rate of 1 full percentage point?
Well, they can issue short-term notes, so that can bring down financing costs. As far as the long end of the curve, Secretary Bessent is working on that with bank capital requirements this summer. They'll create a lot of demand for banks to hold treasuries once again. They can issue on the short end and do an operation twist type of situation where they buy in the long end of the curve, bring down 10-year yields, bring down 30-year fixed rate mortgages. And by the way, I don't know if Powell will be successful, but I do think Bessent will be successful in bringing down the 10-year yield, which is going to bring mortgage rates below 6% before the end of the year. And that's going to be a good thing, as well as the stable coin demand for treasuries, the bill that was just passed yesterday, the Genius Act.
You brought 2 stock picks with you. We've got to get through them fast. First off, GXO Logistics, GXO.
Yes, this is a Brad Jacobs company. The last Brad Jacobs company I came to your audience with 2 months ago was QXO. It's up 65% in the last 2 months. This one we believe is just taking off. It's a worldwide logistics company. 2 catalysts. Number one, the CEO announced he was retiring several months back, so we're going to get an announcement of a new CEO. That's going to be a positive catalyst. And number 2, on June 25th, the CMA, the UK regulatory body, is going to rule on their Wincanton acquisition, whether or not they need to divest the grocery business. The grocery business is only 6% of the revenues of Wincanton. So once that is completed, they can integrate, get the cost synergies, generate over $800 million of EBITDA this year. We think the stock's going from 42 to over 60 before the end of the year. That's a good one.
Okay.
And the second one I got for you.
You've got 20 seconds because we're almost out of time. Albemarle, lithium miner.
Albemarle.
Go.
Lowest cost, one of the largest lithium producers, very cyclical business. Prices are in a trough state. This happens every 5 to 8 years. The story here is energy storage systems. The demand is going to go from 1.2 million metric tons to 3.2 million metric tons by 2030. Albemarle is best positioned, even with trough prices. They're cash flow positive, $3 billion of liquidity. This can be a double to triple over the next 3 to 4 years, Stu.
Well, that was 40 seconds, but we'll let you get away with it. Tom Hayes, thank you very much indeed. We'll see you again real soon.